Cast is now starting. All attendees are in listen-only mode.
Hello, everyone. Hope you're doing well today. You may recognize me. It's Brittany Melville with Next Generation. We have a few special guests here today that are going to bring you some unique education, and we're going to do something a little bit different today than what we typically do. Typically, we focus specifically on self-directed IRAs and how those work with different types of investments. But today, we're going to take more of a global look at alternative investing in general. And we're going to talk about some best practices for incorporating alternative assets into your portfolio and how to avoid making some of those common mistakes. So we hope you enjoy the education session today. You should be able to see here our host, Becca Hennessy. Becca's going to go ahead next, and she's going to introduce our special guest speaker, Dr. Paul Wendy. But before we do that, I just want to quickly mention a couple things. We have about an hour slated for the session today, and the broadcast is being recorded. So if for any reason you missed us live, or if you have to jump off, we will be sending a copy of this recording out to everyone who registered. As well, if you have any questions throughout the session, please feel free to enter them into the question box on the right-hand side of your panel. I'm going to take a look at those, and then I'll read those out either as we go or once we get to the end, depending when it's appropriate. And then we can field those questions for you. With that, let's get started. Becca, I'll hand it over to you.
Thank you so much, Brittany. We're very excited to be here today. And first of all, I want to thank Next Generation Trust Company for inviting us to present here today. I'm your host, Rebecca Hennessy. Before I introduce you to Dr. Paul Wendy, let me tell you a couple of things. Our purpose today is to educate and empower you and help you make a good, well-informed decision with your investment portfolio. In this webinar, Dr. Paul Wendy will show you the 3 biggest mistakes investors make in their portfolios, how to avoid them, how to bulletproof your portfolio, the secret to picking a great alternative investment, plus you're going to learn how to protect your wealth while maximizing your upside potential and dramatically lowering your risk. You'll learn what true diversification is and the magic ingredient to a well-balanced portfolio. Plus, we're going to show you how you can incorporate alternative investments into your retirement accounts. We're going to show you the strategies that the 0.5% of hedge fund managers use. Plus, we're going to show you the secrets the most profitable hedge fund managers use, the secrets no one else will ever tell you. But first, I want to introduce you to Dr. Paul Wendy. Dr. Paul Wendy holds a doctorate in business administration and finance. He has spent the last 38 years obsessively studying, researching, investing, and teaching some of the most powerful investment strategies that bring higher returns, and most importantly, at a much lower risk. Dr. Wendy has dedicated his life to studying, learning, and teaching some of the most powerful and profitable investment strategies you'll find anywhere. He began his career early on in the research department of First Affiliated Securities. Then he later moved into the due diligence departments of Anchor National Life and Anchor Financial Services. And from there, he became a portfolio manager with the famous Harris Bancorp. Dr. Wendy later was the director of corporate finance and director of equity research for Brook Street Securities, a major independent investment banking firm. And then he moved on to senior management positions at Evergreen Realty, where he started and managed the firm's real estate investment trust. Dr. Wendy also started his own investment banking firm, South Lake Avenue Securities Corporation, which specialized in the syndication of alternative investments. Clearly, he understands how important it is to perform due diligence. As an investment banker, he has more than 38 years of experience with successful funds in the alternative markets, and they range all the way from real estate to private equity. Plus, he's a Forbes publication contributor. The reasons why Dr. Paul Wendy is so unique is his extreme passion, along with his absolute transparency and his strong business acumen. Let me give you a little more information about Dr. Paul Wendy and why the message he will give you today is so important to you. A number of times in this webinar, you'll hear the word unique being used. And there are a couple of things that are in fact unique about what we have here today. What makes Dr. Paul Wendy unique? He is unique because of his 38 years of experience and his passion for financial wealth building and educating everyone who's interested in building their financial wealth. His doctoral thesis is centered on a financial concept known as intrinsic value. It is the basis of how he assesses and values all of his investments. As you learn more about what Dr. Paul Wendy does, you will see that it is the same as the very top multi-billion-dollar hedge fund managers. But the unique difference is, instead of working with multi-billion-dollar hedge funds, he has been able to apply these same principles directly to help smaller portfolios. Because your goals are preserving your wealth, maximizing your upside potential, and lowering your downside risk, right? As you pay close attention, you'll see some important distinctions. The difference between a good portfolio and a bad portfolio. The difference between a high-risk portfolio and a dramatically lower risk portfolio. So, Professor, what is the first biggest mistake that investors make with their retirement portfolios?
Well, thank you, Becca. And first of all, I have to say I couldn't have said all that better myself. So thank you for the introduction. Well, I think the first thing we have to look at is, so the first big mistake is that people just don't really allocate their portfolios as well as they could be. And even more importantly, they don't really diversify in the way they should be doing. But first let's look at what alternative investments are, because that's what we're really talking about today. That's the subject of today's talk. And we're looking at how we can put alternative investments into a portfolio to both increase the returns and lower the risk. It's kind of interesting because I read all the time and I teach courses to MBA students and many others in investments, economics, finance, and so forth. And I was just reading something last night. My habit's to get up in the middle of the night when the house is quiet and I have kind of time to myself. And I read for 1 or 2 hours. So I'm always reading new stuff. And I was actually, I read a couple of things last night that sort of surprised me. Intellectually, I get it, but I'm still, surprised every day by just how portfolios are run and how they're not run. One of the things I just ran across in the last couple of nights is that John Maynard Keynes, the famous British economist that we know now as having founded what we call Keynesian economics, back in the early 1900s, 1920s, 1930s, he was actually in a position where he was trying to convince King's College and other investment portfolios to diversify away from what we would call today alternative investments. They were investing in a lot of real estate. He was trying to talk them in those days into investing in stocks. Fast forward 100 years later now, we've got people investing in stocks plenty. We're now trying to convince them to go back into alternative investments.
Exactly.
The other thing I was just reading yesterday too, that people are still talking about the 60-40 stock, 60-40 stock bond portfolio. So 60% stocks, 40% bonds. And again, that's I know that's what a lot of people are investing in, but there's other alternatives, and that's like what we're talking about today is the whole idea of using alternative investments. By the way, back when I was a portfolio manager with Harris Bancorp, we back then were in the Arizona subsidiary that I was working in. We were just starting to diversify portfolios away from stocks and bonds into real estate. And I think this was in the mid to late 1980s. And I think we were a little bit ahead of our time, at least for trust companies back then. But the message has really been the same for a very, very long time. You need to be in all the different asset classes, stocks, bonds, and alternative investments. So, what are alternative investments? And alternative investments span a very wide range of things. And we're going to talk here, just in a moment, I'm going to give you some examples of alternative investments. But just generally speaking, and please don't hold me to this definition exactly, this is just a really rough generalization. but basically an alternative investment is anything that's not a stock or a bond. Now, again, that's a very, very broad definition. But I think that's what most people think of when we think about alternatives. And a lot of people, frankly, just don't understand, what alternatives include. So here's some examples. We've already talked about real estate. Real estate is one of the big asset classes for alternatives. And by the way, I ran across, as I was doing some research for this webinar I'm doing and for a couple of articles I'm writing, I went through a list of alternatives. And although I've been at this for really 38 years, some of these things even surprised me, but they are alternatives. So here's some examples. Besides real estate, there's commodities. And by the way, I don't necessarily say that you should invest in all these, but I'm just trying to give you a flavor for what the category of alternative investments includes. So real estate, commodities, international equities, which by the way, I think most portfolios should have an allocation there. High yield bonds, otherwise known as junk bonds. One of the school portfolios, major university portfolios that I advise the students, we're talking about their allocation to the fallen angels. That's what we oftentimes call the junk bond or the high yield bonds. And I commented to them, I said, so the fallen angels fell a little bit further, which they had. Anyway, another category is private equity. That's a fairly popular category these days. I think that's probably a category that deserves some attention. We're looking at private equity for our own Northwest Quadrant Opportunity Fund. Covered call writing. Now that's something that, gosh, since 1982, when I was a stockbroker with Bateman Eckert Hill Richards out of Los Angeles, and we actually going back before then, when I was a sophomore or junior in college, the Chicago Board of Auctions first came into existence in 1974, I believe.
Oh no.
I'm beyond. Am I still on? I see my computer screen's rebooting.
You just looked out for a quick moment.
Okay.
The audio was on.
Okay. Which part was I? Did you hear me talk about covered calls?
Yes.
Okay. Anyway, we've been doing covered calls. I mean, not we in a general sense, right? Since 1974, when the Chicago Board of Options Exchange came into existence, covered call writing kind of came in. So I've never thought of that as being an alternative investment, but that's certainly part of the category. Convertible bonds, and by the way, let me mention too that in our portfolios, and I think again this is kind of a general educational call for people to get a sense for what alternative investing is all about. I think you should be looking at both private investments and alternatives as well as public. And so, for example, there's some very good convertible bond funds, but convertible bonds are considered alternatives. Precious metals, preferred stocks, emerging market stocks and bonds. So emerging markets are the smaller countries, the less developed countries. We call those emerging markets, and there's some good investments perhaps in some of those stocks and bonds. Let me say though that that's an area that most people, including us at Northwest Quadrant, we don't have any direct experience in picking investments in, say, Chile or Peru or Yugoslavia. But that's kind of the point too, is that there is plenty of expertise out there that we can tap into, and that's what we do with our fund. We're actually a fund of funds with Northwest Quadrant, so we're investing in asset managers that do understand the various asset classes. Even though some of the asset classes we understand very, very well, we're still trying to choose managers for our own fund that really specialize in those categories.
That's fantastic.
Yeah. Let me just a couple of real other things here real quick. So there's hedge funds, leveraged buyout funds, and then one of the areas that we are looking at for investments is the secondary market for alternative investments. So a lot of the alternative investments that we that we invest in, people will have invested maybe in a real estate limited partnership or something, and for whatever reason, they have to sell that investment. Maybe they need the money for college, for their kids, or retirement, or whatever the case may be. When those assets go on the secondary market, and we have access to those secondary markets, most people don't. There's some really good bargains out there that can be found. In other words, you can get those assets for a very good price, very good discount. Did you want to jump in there, Rebecca?
Yes, so I just want to be clear, and by the way, the one thing I love the most about you, Dr. Paul Windy, is how you are able to take this amazing wealth of information, 38 years experience, and pare it down so that we can understand. So what percentage should a portfolio, a healthy portfolio, have in alternative investments? What is the percentage you would say for most people?
Yeah, and it's hard to say in a generalized sense, because everyone's portfolio is unique and different, and you really have to look at it on an individualized basis. My general sense is that probably somewhere around 20% is is a good allocation. Now, I was moderating a panel because we're very active in the alternative asset industry, and so I go to conferences of the firms that specialize in alternative assets. And I was moderating a panel at one of these. Some of my fellow panelists were saying that allocations could be as high as 40 or 50%. Personally, I think that's probably too high. But again, it's an individualized basis. Now, I will say that my fellow panelists, they had a little bit of a vested interest, we'll say, in alternatives, right? But in general speaking, I would say 20% is probably a good number to use as a starting point.
That's fantastic. So step one to dramatically lowering your downside risk is allocating at least 20% of your portfolio into an alternative investment. Professor, let's move on to. Oh, go ahead.
Let me just make one other point real quick too, is that I think we have to ask, why we should even consider alternative investments. So we talked about what they are, give some examples, how much should you allocate, but why should you even consider alternative investments in the first place? And there's really two reasons. Number one is that alternative investments tend to give higher returns by their very, very nature. And as we'll talk about here in the next couple of questions, used properly, they can actually reduce the risk very dramatically of the overall portfolio.
Wonderful. Thank you so much. So, Professor, what is the second biggest mistake?
So the second biggest mistake, I think, is, I'm waiting for these slides to come up, is, hopefully you all can see this on your screen. The second biggest mistake that people do in their portfolios is they really don't diversify properly. Now, you can, a lot of people think about, well, okay, if I diversify a portfolio, I'm going to put a bunch of assets into the portfolio, and that'll make them diversify. Some people think that maybe putting 50 or 60 stocks, for example, into a portfolio gives good diversification. The real key to diversification is not the absolute number of assets and investments that you put into a portfolio, but it's really how they're correlated with each other. So by the way, the average correlation with the stock portfolio is about 35%. That's actually, so if you're diversifying just the stocks, not considering alternatives for the moment, if you're just diversifying with stocks, and you have, it turns out the number is about 25 different stocks. So if you have like 25 stocks in the portfolio and they're in different sectors and different industries, then you're probably getting the benefit of that 35% average correlation. But on the other hand, if you put into a portfolio, you put 50 banks and nothing else, you put 50 utilities and nothing else, then you're not really diversified well, because the correlation between those assets is very, very close, probably closer to 80–90% correlated with each other. This chart that we're looking at here is one I often use with my finance and MBA classes, and it gives an example of a 2 asset portfolio, Ford and AutoZone. Now the key is that dashed black line, you notice, has a slight positive slope on it. So the key is that we're saying that if you were to invest in a two asset portfolio, you would invest with the expectation that both these stocks would be increasing over time. But as you can see from these two assets, Ford and AutoZone, they're, as we've shown here, they're negatively correlated. This is theoretical, of course. So this is just for an example. But the idea here is that in a good economy, people are buying new cars. So Ford Motor Company might be doing well because people are buying new cars. AutoZone, on the other hand, is going to do better, relatively speaking, in a down economy, because when the economy goes down, people have to keep their cars longer. So they're going to be buying aftermarket parts to keep their cars running. And again, this is just a theoretical example, but it kind of illustrates well how this idea of negative correlation works. So when Ford's going up, AutoZone is going down, and vice versa. Again, for this really to work is that you have to, over time, have both these stocks appreciating. But you can see what happens is that we define risk in the investment world as being the volatility of returns. In other words, as I always tell my students, the risk is what makes your stomach upset, what keeps you awake at night, which is basically the fluctuations in the market, right? And so if you can keep those fluctuations to a minimum, and you do that by using low correlated assets with each other, then when one's going up, the other one's going down, and they kind of tend to cancel each other out. So that's what this chart is showing.
Wow, Professor, that's a very powerful way to show us how to lower your risk while still maintaining a strong upside. Can you take us a little bit deeper into that strategy and explain to us how many non or low correlated investments we should have in our portfolio?
Sure. We're waiting for the next chart to come up here. So a couple of thoughts on that. Generally speaking, most investment managers and academics, for a stock portfolio, again, for the moment, we're not talking about alternative assets, but for a stock portfolio, if you have about 25 stocks in a portfolio, you're going to really maximize the benefits of diversification. And so let's see, this one's non-low correlated investments. What this chart is showing is that, okay, so if we take over on the left-hand side of the screen, by the way, the vertical axis is standard deviation. That's how we measure risk in a portfolio. Standard deviation is just a statistical measure which measures volatility. So in other words, the ups and downs of the portfolio. And along the horizontal axis, we have the number of stocks or various assets that you have in the portfolio. So with a one asset portfolio, so we're starting out there at the very, very top left. So where, thanks. Well, that your pointer is there, where all those come together. That's a one asset portfolio where you're assuming that the asset has a 10% return and also a 10% risk. Okay. Now, as we move along the horizontal axis, we're adding different assets. So in this case, one asset, two assets, three assets, and so forth. But at the same time, we're adding assets that have low correlations with each other. So the top red line is a correlation between assets of 60%. The bottom, I can't really tell what color that is, maroon maybe. That's a correlation of 0%. And then they go like 60 and 40 and 30 and 20 and 0, I think, something like that. Anyway, the correlations decline. And you can see that as you add a number of assets and the correlations between those decrease, you're reducing the risk of the portfolio. Again, the portfolio risk is measured by the standard deviation on the left vertical axis that's labeled standard deviation. So that's really the key. Again, for just a stock portfolio, you maximize out the benefits of diversification, typically around 25 stocks. So if you have a 50 stock portfolio that's well diversified, you're getting actually closer to being an index fund. And again, once you hit about 25 stocks, you really maximize the benefit. It's okay to have that many, but you're not really accomplishing much by having more stocks.
That's great, Professor. So if I'm looking at this chart correctly, having 6 correlated or non-correlated, I should say, because I'm just learning this, investments are good. But if you have 15 to 20, that's even better, right?
Exactly. And again, with that caveat that once we get to about 25 assets that are have low correlations with each other, then you pretty much maximize the benefits. Now, I think we have a couple more charts coming up here where we talk about adding alternative assets. And so these lines show what happens as you add assets which have low correlations, again, from excuse me, 60% on the top line down to 0% on the bottom line. But many of the alternative assets have actually lower low to negative correlations with other assets. So that's typically, so we talk here about the idea of true diversification by adding alternative assets and even bringing the risk down. We have a chart which we're going to show here in a couple of minutes where we can show mathematically that we can actually reduce the risk of the portfolio down below the risk of the market. When I say the market, I'm saying the stock market, in essence, as represented by the S&P 500, by using alternative assets properly. We can actually, again, we can show this to you mathematically. We can actually reduce the risk of the portfolio below the risk of the market while still achieving a higher return than the market provides. But we'll show that in a minute.
Wonderful. So I just want to clarify then, the step 2 to dramatically lowering your risk, we should apply true diversification, right?
Correct. Yes.
Okay. And then, Professor, let's move on to the third. What is the third biggest mistake? Because I know you're anxious to tell everyone.
Okay. Well, so the third biggest mistake is just getting involved in investments that you really don't understand. Without someone that does understand that, or doing a lot of homework, or actually both. I really, being an educator, I really advocate that people learn as much as they can about these things. And so, what at Northwest Quadrant Opportunity Fund, what we do really, really well is to pick good managers. We've been doing that for 38 years. And so again, even though we have had many, many, many years of experience on both sides of it, as investment bankers in choosing the asset classes and the asset managers, and as on the sponsor side as well. So we have a lot of experience, particularly in the real estate arena. But we want to be in other asset classes besides just real estate. And even in the real estate arena, that's a full-time job. We think it's better for us to spend our time just being good asset manager selections and let the asset managers manage the assets that they do really, really well, and they do well on a full-time basis. This chart that just came up is what we call the double alpha strategy. Alpha, as you may or may not know in the investment world, alpha is the return that you get above what would be predicted by the risk-return line. So that solid black line that's at about a 45-degree angle, doesn't necessarily have to be, that just happens to be what it is, but that risk-return line plots different assets and asset classes. So on the very, very left-hand side, down at where the vertical axis, right where the pointer is right now, where the vertical return axis and the horizontal risk axis, down there is low returns and low risk. And so the really fundamental trade-off in the investment world is, if you want high returns, you have to take on higher risk, and the converse is true as well. If you take on high risk, then you should expect to get high returns. And you can sort of conceptually, graph this out using that risk-return line. And so the alpha is when a manager is able to produce a return that is above that risk-return line. In other words, the risk-return line says for any given asset class, which you should expect to get in terms of return would be on that line. But if you can produce better than that, then you're really doing your job as a hedge fund or a portfolio manager. So our double alpha strategy, what we're saying is that just because we've been doing this so long, and that's, I think, really kind of the key to this, is that 38 years is a long time. I started out in 1984, as Becca mentioned earlier, working for a firm. My sole job in 1984 as a very, very young guy just starting out on Wall Street, was to do due diligence on alternative investments and of all kinds, real estate, oil and gas, equipment leasing, horse farms. I had a really nice trip one fall up to a horse farm in upstate New York in the fall. It was just a beautiful, beautiful trip. Anyway, that's what I did. Is I spent hours and hours and days and weeks and months just analyzing these individual investments. And so I haven't actually forgot where I was going with that train of thought. But so that happens to investors a lot. Anyway, so we've been at this a long, long time and picking managers, asset managers that we think do a really, really good job. So that's the first level of alpha that we provide that's the alpha that shows the vertical line, and it actually goes up to asset class and manager selection. So that alpha is just the fact that we've been doing this a long time, and have some experience in doing that. And again, we've been able to produce alpha, just again with our Rolodex and our experience in doing this. The second alpha, and as I mentioned earlier, when you use alternative assets effectively, because of their low correlation, they're typically low correlation characteristics with other assets in the portfolio, you can reduce the risk of the portfolio down substantially. And that's what we're showing there. So that little pink box, I guess it is, risk reduction by diversification. And actually, again, we can show you mathematically, how it works, at least in a mathematical sense, how you can reduce the risk of just a standard stock portfolio down below the risk of the market by using alternative investments. And that's the second alpha. So first alpha is superior manager selection, which we strive for. The second alpha is the risk reduction by adding alternative investments to a portfolio.
Excellent information. So in your double alpha strategy, can you show us what a well-diversified portfolio might look like?
I don't know. Let's see what the chart shows. Okay. Yes, well, that's what it would look like. Let's see. So again, what we're saying is that you would take a 60-40, 60% stock, 40% bond portfolio, add some alternative assets. Maybe many of these assets that I mentioned before. Now, again, we're not going to necessarily invest in all these different asset classes. I just mentioned those earlier to give you a sense for what the category of alternative investments includes. But we're looking at, in the Northwest Quadrant Opportunity Fund, for example, we're looking at adding 10 to 15 different asset managers, okay, in a number of different asset classes. So an asset manager, we sometimes call them a sponsor, might specialize in hotels or self-storage. And that's all they do, is that's their business, is to manage self-storage facilities, for example, which, by the way, happens to be a very good asset class right now for a lot of the reasons you can probably imagine. And so we would pick one or two different asset managers that do really, really well with self-storage, and then we pick another asset manager that does well. Strangely, it might be hotels, although we have at least one asset manager that we're pretty close to. We've known for quite a number of years in the hotel arena, and they're just doing a lot of things right. And they're even raising money to buy hotels from distressed operators, because for obvious reasons, a lot of hotel operators just aren't going to make it in this environment. Right. They've got some things that make them, very, very good at what they do. And so anyway, so we're going to have, asset manager that does self-storage, another one that does hotels or whatever. And 10 to 15 of those asset managers. Now, what you have to realize too is that we're diversifying not only across asset managers, but across asset classes. And then each manager, so, say a self-storage manager might have in their portfolio 2 to 3 different self-storage units. So when we actually start talking about the number of assets, it's much greater than 10 to 15. Right. It could be as many as 45 or 50. And And what we offer with our fund, because you asked, Becca, is the ability to get into a very, very well diversified fund across 10 to 15 different asset managers and asset classes, 40 to 50 maybe, or 20 or 30, however many it is, different assets for a very, very small investment, and a much greater level of diversification than most people could achieve just by trying to go out and diversify that like that by themselves.
Right, right. So, Professor, I just want to review what we've already learned. You can dramatically lower your risk by doing these three things. Step one is allocating at least 20% to your portfolio, in alternative investments, applying true diversification to your portfolio, and leveraging resources to find the best managers and apply the double alpha strategy. Is that right?
That's correct, yes.
Wonderful. Professor, I love the quote that you have, and I think it really sums it all up. Finding a good, solid investment is important, but no one good investment can match the power of a truly diversified portfolio. Before we answer any questions from the audience, Professor, are you available to help clients of Next Generation Trust Company?
Oh, absolutely. Absolutely, yes.
Wonderful. I'll go ahead and display the contact information. Any questions?
All right, let's see. I'm going to come back and join you guys on camera. I wanted to give you the attention you deserved. We'll see if we have any questions. And sometimes it takes a minute or two for folks to enter them in. So we'll give them a minute.
And we're always available for questions after this as well.
Okay.
Actually, I do have a quick question if you're still looking for some. Dr. Paul Windy, you started mentioning about the managers who manage the assets. Is it easy for someone to go out and just find all those managers, or is that something that because you have so much experience, you're able to have a bigger Rolodex, if you will?
Yeah. Well, yeah, and again, that Rolodex has been building for 38 years. By the way, that gives you some idea of our age, because we're still talking about Rolodex, right?
Your age. Your age.
Yeah, my age. I mentioned that some of my students, this slide looked like, what's a Rolodex? But yeah, we've been developing those contacts. The alternative asset market, if you will, arena, is really it's not completely fully developed yet, well, and I shouldn't say it's just not well known yet. It's developed from our standpoint. Again, we've been doing this for 38 years, and we know the sponsors, we know the due diligence team. Our extended team, basically, are the due diligence firms. What I used to do when I worked for individual investment banks, they don't typically have people like me anymore. They farm everything out to firms that have grown up, and that actually kind of started happening after I was already in the industry. Firms started cropping up to just do due diligence, and so again, they're specializing. That's all they do and they have wonderful resources to do this. So we include those as part of our team when we find asset managers. Now, many of these asset managers we've just known for so many years anyway, but even the ones we've known, we'll still hire the due diligence firms to go out and look at the, really, kick the tires and just do all the legal background checks and the, review the assets, run projections. It's a very, very thorough due diligence job that they do. So, but again, that's, we know the investment banks, we know the due diligence firms, we know the sponsors. We're part of the industry. We go to the conferences, we speak to the conferences, and so forth. I also wanted to mention, just yesterday, I mentioned that there's a secondary market for some of these limited partnership interests, and we do take advantage of that secondary market because there are some really very, very good bargains out there. Well, this little communication I got from one of the firms that we work with, if I can find it here, they basically said. So they're like a secondary marketplace where you can go in and buy alternative assets what's nice about the secondary market is that these are assets that are usually seasoned. So, someone may have a firm, a sponsor, may have started, say, a real estate project, an apartment building or a self-storage unit 3 or 4 years ago, okay? And then someone that bought one of those interests in that partnership or LLC, whatever the structure is, now has to sell it because their kids are going to college or they're going to retire or, whatever the case, they've lost their job. And so it goes on these secondary markets, and they're usually priced at pretty steep discounts. But not only are you getting a good buy in terms of the price, but you also have a seasoned asset. And you can see this is an asset. When the original person bought it, it was a brand new, brand new project, or at least to the sponsors, brand new. Now the sponsors had it for 2 to 3 years. We can see how it's been performing.
Right.
So here was a little piece that came in. I wrote this down to be able to quote it. So this is again from the firm that runs one of these secondary marketplaces. It says, we have, in quote, we have institutional buyers, okay, actively looking to purchase larger share quantities of the REITs below, and it listed a bunch of REITs. So the institutions get it. They've been doing this, the larger institutions have been doing this for a long time, the BlackRocks and so forth. What we really do is kind of bring this down to, the high net worth individual, the accredited investors, the small pension funds, family offices, and so forth, and provide, kind of that expertise and that, just that experience and that Rolodex of being able to find these.
Wonderful. Thank you. Brittany, were there any questions?
I don't see any. However, we still do have a group of attendees on that are listening. So if I can ask a question without putting Dr. Paul Wendy on the spot.
Go ahead, put me on the spot.
So we talked about alternatives and allocating them into an investment portfolio. So one of the things that I think our listeners are aware of that we assist with is ways to utilize not just an investment portfolio, but a tax-advantaged retirement account in order to incorporate alternative assets. So do you have any comments on that angle as a strategy and the benefits of that?
Oh, absolutely. And I'm glad I actually was going to bring that point up, and I'm glad you reminded me. The self-directed IRA is just an excellent vehicle to be able to do this. We've actually been doing this. Again, I've been doing this for 38 years. I don't know how long. It probably goes back to 1984 when I started doing this. But and a lot of people don't realize just how a self-directed IRA, for example, or other types of retirement plans can be so beneficial. People oftentimes think that in their IRA they have to buy, stocks or mutual funds that are traded on one of the exchanges, but not at all. And it's really, it's really just a great thing that people do have, like the vehicles that your company, Brittany, provides to be able to buy these kinds of assets. So yeah, when I was on both sides as an investment banker as well as being on the sponsor side, we would set up self-directed IRAs all the time so that people could use them to make these kinds of investments. Does that answer your question?
Yes, it does. And I think, and one of the things that as you were talking, I was thinking about maybe some of the common mistakes that self-directed IRA holders might make, or some of the issues they might come up against throughout the course of using a self-directed IRA. And I think one of them is getting into alternative investments that they don't fully understand.
Right.
And I think that ties back to, I think it was your number 2 or part of it. And where your knowledge comes in and is important is we act as a custodian for these accounts, meaning that we can help set them up. We hold the retirement accounts and we provide all of the necessary reporting and record keeping on these accounts, and obviously assist with the transactions associated with the investments. But because we're not fiduciaries, we don't have the ability to perform that due diligence for them. So in some cases, investors are coming into these decisions with either limited due diligence or no due diligence. Maybe it's a recommendation that they got from a friend to invest in a specific, private stock, or maybe a specific real estate fund. And that's okay. And of course, investors are free to choose their own. And that's part of the beauty of having the self-directed IRA. But if they're really looking for some more insight and expertise behind the decisions that they're making, then understanding this is important as well. And I just wanted to point that out because I think it's a complement to what we do.
Yeah, I think we probably should have put down, Becca, and we should put down the fourth big mistake that people make is they don't do the due diligence. And I can tell you the horror stories I've seen in 38 years. It's tough. I mean, and that's why we spend, and I guess the nice thing is I'll tell you one of the little, one of the true kept secrets of the industry is that the due diligence that we, in essence, hire to be done, we actually don't have to pay for that. It's kind of like a firm, that's getting a CPA to do an audit on them. All right, the firm's going to pay the CPA. The investor doesn't pay the CPA. Well, it works the same in the due diligence arena, which is great because some of these due diligence assignments can be $25,000 or more. And the sponsors of these investments are willing to pay that because we're all part of this investment banking community and community of firms that deal with alternative investments all the time. They're not spending $25,000 just for us and then $25,000 for somebody else. They spend the money, and everyone that's part of this community can use it, and that's what does happen. But the point is that we have some, these due diligence firms that we hire will spend, several, 2 to 3 months at least, looking at these companies and their investments, and then we'll be doing ongoing due diligence as well. So it's a very expensive, very lengthy process, and if you don't do that, again, in 38 years, I've just seen cases. I mean, it's even tough when people do everything right. But if you don't do the due diligence, it's almost a guarantee, almost a recipe for a disaster.
Right.
Yeah, I think we have many investors have been successful using self-directed IRAs, but one of the factors into having the success, especially long term, is the education behind knowing what you're investing in and getting into. So I think that part is really important, and I don't know that it's emphasized enough in sort of the self-directed IRA community in terms of conversations that people might be having and like the word of mouth that's spreading around it, and maybe even the way that it's sometimes marketed to people. I don't think that part is stressed enough because of course people want to hear that, it's easy, you just pick your own investments and everything's great and you're gonna accelerate your return on investment, and obviously that's a real possibility. But I think in order to increase the probability that it actually happens, you still have to do the work behind it.
Right.
Absolutely.
So yeah, definitely important. All right. Let's see. I don't think we have any other questions. I think you've probably given our listeners a lot to think about and take in. We'll do a time check. We have a few minutes. Are there any other closing comments that you'd like to make or any other points that we missed?
Becca, did you have anything that we should be adding, or let me look at my notes here real quick?
I'm actually really excited that we made it through. I feel like I said before, Paul, your genius is the fact that you can take these complex things that you're doing and all this knowledge you have and pare it down into 3 or even 4, Brittany, easy steps for everyone. No, I think just in closing, there's all of the contact information for Dr. Paul Wendy. He's already said that he'd be happy to help your clients with anything, any questions that they have. And again, it's been a pleasure to present today.
And Becca, the genius, actually, if I grew my hair out, the genius you would see is just the gray hair, having been around a long time.
Professor, you look great.
Oh, thank you. I just pictured an Albert Einstein
Yeah, right,
like,
exactly.
coming out of either
And that's
end.
exactly what it's like.
That's what it would be.
It seems
Well,
appropriate.
thank you so much.
Absolutely. No, I appreciate the time from both of you today and all the knowledge that you brought to our group. Obviously, not an area of expertise for us, so we're happy to be able to offer something unique and different, and we appreciate your willingness to share and contribute all of that. So,
Absolutely. And Brittany, any time. We love to do this. I mean, that's what our program is all about, is educating and empowering. So anytime you'd like us to write something, do something, we're here for you.
Yep, and as are we, we're really motivated to educate as well, as you know. We really want to, I think we all want to set investors up to be successful, right? We just want to see people be successful and be educated and feel really good about the decisions that they're making and the path that they're taking. So the more we can continue to do that, the better everyone will be. With that, thanks everybody for joining us today. We really appreciate it. And we also hope that everybody is safe and healthy during this crazy time. It really is something.
Yeah.
But with that said, I think just a closing comment would be that it's also a good time, as you probably have all thought about this, to be having these conversations, because we've seen what the market can do. So anyone who's listened to this today and took the time out of their day to educate themselves in a proactive way is putting themselves in a good position to really get ahead of most others when it comes to finding ways to hedge against further volatility, right? So I'm sure this isn't the last volatility that we're going to see, right? It's a roller coaster.
Oh, no.
So we got to ride the roller coaster, but we got to be smart about what we're doing on it. So
buckle in.
Hopefully it's been helpful. Yeah, buckle in for sure. And for anybody who would like more information, we'll be following up within a day or so with an email to everybody, and we'll have contact information for our speakers, and we'll also have a recording of the webinar. So if you would like to have a one-on-one discussion, or maybe you think about this and some other questions come up and you feel more comfortable discussing them at a later date, we are all accessible. So thanks again. Everybody stay safe. Have a wonderful rest of your week, and hopefully we'll be talking to you soon.
Thanks, everybody.
All right. Take care.
Bye-bye.
Bye.